Well, hello. It's been a long time before I come back with a video, and I'm happy and glad that I'm able to meet you today for finance and economics data analysis. And the data that we're referring to is from Kaggle. Kaggle is an open data source, and this is the website that I'm referring to. And so the data of concern today is that of finance and economics data set that is from 2000 to present. And if we look at it, then it's the finance and economics data set provides daily financial and macroeconomic data, including stock market prices, GDP growth, inflation, interest rates, consumer spending, exchange rates, and more. It is designed for use in financial market analysis, that is to track stock index movements and trading volumes, macroeconomic research study, macroeconomic research, study economic trends, including inflation and GDP growth, investment decision making, that is in evaluating interest rates, corporate profits, and consumer confidence. Now, it can also be used for machine learning and predictive analytics to develop forecasting models for economic indicators. So this data set is valuable for economists, investors, data scientists, researchers, and policymakers. Now about this data, much of this we may see once we load the data. What I wanted us to see here then is that this is the data that we need to, we have to engage with. So first, what I'll do straight away, I'll get to Jupyter, and that's where we are. So probably we start by creating a new notebook, and that's that's the new notebook that we have. So probably I may want to rename it. Let me call it market returns. Just want to name it market returns as such. So that's our new notebook that we want to work with. So the first thing, prior to this, I'd considered my codes because I didn't want to take much time trying to figure out the typing codes and also debugging where there may be issues. So first, I prepared this beforehand, and what I'll be doing is just getting straight away. So as I've shown you that we'll be working with Kaggle data, this is the data set that I want to pick. So what I'll do first is come here. The data set is this. So I will come under download, then I copy this. Okay, upon copying this, it tells me import Kaggle Hub. So this will provide me with a path of interest. So I bring it there, and that's what I have. So first thing I do is to run that. Once I've run it, it will specify, because I asked it to print the path to dataset files. So it has printed that path to dataset files is that which we are seeing. So the second step, I'll go to my notebook as I've had it. So I need to import the necessary libraries that will enable me bring this data set where I want it. So first thing I'll do is to bring this here. So the first library I'm talking about is import Pandas as PD, then also import OS. Now these ones, these libraries will assist me. The first one, import Kaggle Hub, assists me to access the download from the Kaggle website. But this other one now assists me in uploading this into my notebook. So Pandas does that, where we import Pandas as PD, and we also import OS. Now, upon running this again, then we'll see that the particular name of the data set is finance economics datasets. It's a .csv. It's a .csv file. So once I've specified that, the next thing that I needed to do now is to bring this other code. Realize that these ones are prepared beforehand because I didn't want to take much time typing them. So upon bringing this here, that's what I have. If I run it, then it gives me all this. So what it has done is that it has accessed the data from the website directly, and it is real and live data, as we can see. But then what we see here is that we have columns. So probably before we get here, I can now let me first do a little inspection by saying df.info. So that will help me identify the columns that are in this data set. So here we see that there are 300 entries. That is from 0 to 2999, and there are 24 columns. Now these columns, the first column is date. We have stock index, open price, close price, daily high, daily low, trading volume, GDP growth percentage, inflation rate percentage, unemployment rate, interest rate percentage, consumer confidence index, government debt in billions USD, corporate profits in billions USD, forex USD stroke euro, forex USD stroke Japanese yen, crude oil prices in USD per barrel, gold prices in USD per ounce, real estate index, retail sales, that is billions in USD, bankruptcy rate percentage, then mergers and acquisition deals, venture capital funding, consumer spending in USD, billions USD. Now you can see that this is such a rich data set, and it can assist in understanding much of what we are interested in doing. So this one gives me, and I asked it here to print df head. Df head simply means by default it gives us the first 5 entries in the data set. So we see that the first column is the date, and here we see it. Then stock index, we see we have Dow Jones, S&P 500, Dow Jones, etc. They keep oscillating as such. Then the values there for various columns that we refer to. So that's basically what the F head does, and that's what it is. So the df info here was just meant to help me identify the columns as they are, and I see that this is what they are. Now we can see that date is an object because probably it contains also non-numeric. It contains there are some hyphens in it. Then open price, you see it is indicated float when we expect it to be an integer, meaning that they may be having the element of commas, so and so on and so forth. So what we do next, having done that, is I want to pick the next thing. The next step probably is that of having to clean. That is to, there are certain columns here that are likely to be having outliers. And such columns, as identified, will be close price column, GDP growth percentage, and inflation rate percentage. And I'll be using, I'll be removing outliers by setting the first quartile at 0. The first quartile I'll set at 0.25. That's the first quartile, and the third quartile, which is the upper quartile, at 0.75. So this is going to ensure that I take care of values which may be extreme on the upper tail and the lower tail. So upon picking it as such, I bring it here, and that's what it gives me. So once I run, it tells me that after selective outlier removal, we have 3,000 rows and 24 columns. So basically, the data was clean, and there are no rows that have been eliminated, and that's why we have that. So the next step, I didn't intend this video to be so long. The next step is now to pick the code that should give us the main topic of this analysis. So I'll collect it, and probably after collecting it, that's when I'll describe it briefly. Yeah. So let's see what it is here. Is that first thing what we need to do? It is market daily dynamics analysis. So all these are libraries that we have imported to assist us. There's NumPy to help us with handling the figures. There's plotly.graph, that is for visualization, and also pyplot from Matplotlib for visualization. So the first part here, we load and prepare the data, and that's what it is. So load and prepare the data, that's what it does. This one will now convert date column to date time and sort it. Then the third one here will compute daily returns and volatility. And this one will help us get the plot and as such. So the fifth one here, okay, the fourth one should give us the plot, daily returns, and rolling volatility. And then this should give us the summary statistics. So let me run it and see what we have. And then we see what we can make out of it. So probably that's what we have. And as you can see, we already have an output. This output here is that of daily market price movements, and it is plotted as such. So this one is for visualization purposes, and bear in mind that we are dealing with global data, and it's global data that runs all the way from 2000 to present. So what we have here is the market returns and volatility over time. And what it shows us is that it illustrates, probably it illustrates the behavior of daily market returns in blue and 20-day rolling volatility in orange. So both are expressed as percentages derived from the finance and economics datasets covering 2000 to 2008. Now, this dual line visualization offers a concise look at how short-term price changes translate into medium-term risk accumulation. So first, daily returns fluctuate sharply with periodic spikes exceeding 200%, as you can see, exceeding 200%. This represents market reaction episodes, likely responses to macroeconomic news, policy shifts, or global market turbulence. Then we can also see that there is also volatility clustering. The orange line representing the 20-day rolling volatility demonstrates the phenomenon of volatility clustering, periods of high variability followed by calm phases. This confirms a key feature of financial markets, that is, risks tend to persist once triggered. Risks tend to persist once triggered. So the third one, the third aspect we want to look at here is that the cyclical or the cyclical risk patterns. Now, there are noticeable peaks. Noticeable peaks appear around 2001 to 2002, that's here, and 2006 to 2008, aligning with major historical events such as the dot-com correction and the pre-global financial crisis buildup. Now, we can also have another dimension of risk-return trade-off. Now, when volatility rises, daily returns often exhibit wider swings, underscoring the risk-reward trade-off fundamental to market dynamics. So this particular diagram here, this particular image tells us much about the global market returns and its volatility over time. And if you take time to go through it and think through my verbal communication or my lecture, then you'll realize that you can have it or put it in sync with the diagram that you see here. So probably another thing that I need to add, we can now, if that's what we have, that's the situation, that's what the data reveals, then we should then understand some of the analytical implications of the data. So first, portfolio management. Investors can use rolling volatility metrics to adjust exposure dynamically, increasing holdings during calm periods and reducing them when volatility spikes. Another implication can be seen in terms of risk forecasting, combining short-term return shocks with rolling volatility enables the calibration of value at risk, that is VAR, and expected shortfall models. Now, if you want to access the full report of this particular analysis, then you should visit our website, that is datalyticsacademy.com, and then you get to the blog section. you'll find all the analysis that I've ever done, plus their reports posted there. So another way that we can look at the implications of analytical implications of this particular result is machine learning integration. This visualization can serve as a baseline for feature engineering in predictive models such as the GARCH, the LSTM, or random forest regressors, linking volatility persistence to future market outcomes. Now, today, as I said, I didn't want to take much of your time, but I felt it necessary to talk about this particular aspect of the analysis. As you have seen, the data is huge. There is much analysis that can be done. There is much that I've already done. That's why I'm directing you to the website, the blog section, so that you can have a feeling of what data means, because I mine the data as such and use my knowledge to analyze it and avail it for your consumption. So you can visit my website and then check the reports that have been there. Have been there for this time. So down here, then we see summary of daily returns, and we see the count is this, and then the mean is 20.85, standard deviation is 78. Now that's big. If the mean is 20 and standard deviation is 78, I think that indicates uncertainty, wide uncertainty. Now we are talking about a daily mean returns of -79, and that is the minimum -79. The upper quartile, now the lower quartile is about -34. The middle quartile, which is the median, is now 0.32, and then the upper quartile is 53.21. Now maximum big about 390.664. Now I'll take time to look at to consider other analysis, so that we make out the meaning, meaning out of this particular summary. So for now, I want to stop at that, and I hope that you'll follow us to our website, so that you get much insights of what the data that is publicly available reveal about the patterns underlying such data sets. Now, this will be important in helping or shaping policy making direction. I want to stop there, and I'll be coming back with another set of analysis in a moment. So I stop there and see you in my next video.